Awesome, awesome. And I'm excited that Jim blew out his voice. And so I get to take over this week and talk about what we're going to do, as it relates to having lenders and helping our clients navigate to today's unique financial marketplace. But like John said, I'm out of Louisville, Kentucky, and I do sell real estate across the entire United States and multiple countries. I literally have figured out how to make money sitting at this computer, and I do very, very well at it. So we here at Grow Global, this is what we do. We pour into one another. We bring to you the way for everybody to be successful. And this is how we do it, by sharing these strategies every single Monday and making sure that we open up our playbook. So today we have three top lenders that we wanted to bring and introduce to you. These are three top lenders that our own Grow Global top brokers are utilizing to produce in today's market, today's climate. So we want to introduce Dakota, we want to introduce Todd, and we want to introduce David. And so why don't we start with Todd? Give us a brief introduction of yourself, Todd.
Hello, thanks for having me. I appreciate it. Todd Pennington. I've been doing mortgage lending for 29 years. My company, First Community Mortgage, is unique in the way that we are a mortgage company, but we're under a bank umbrella. So that gives us lending ability in almost every state. So it gives us a kind of a national perspective to be able to lend in. So just about every state possible. Done it a long time, know how to get deals done, get them done quickly, great rates, great programs that we'll talk about here in a little bit. So appreciate you having me, and I look forward to the conversation.
Awesome, Todd. Thank you so much. Dakota, who's visiting the Ozarks and has that awesome background today.
Yeah, so my name's Dakota Baisa. I am in the Indianapolis, Indiana real estate market. I'm also licensed in Florida as well. I've been doing this, I'm rounding 6 years now. So I got in and got about 1 year of steady mortgage, you know what I mean, foundation, and then went into the craziness of COVID and have been riding that ever since. So it's a lot of fun. I enjoy what I do. I think I'm really creative with solving problems for my realtor partners and making sure we get just about everyone who's semi-qualified, approved for that home loan. If you have an opportunity, you know what I mean? If you have the foundation, we should be able to get you into a home, and that's always the goal. So, yeah, thank you guys so much for having me here. Appreciate it.
All right. Awesome, Dakota. And now David.
Hey guys, good afternoon. My name is David Riddle, and I'm with Grace Mortgage Services. I am a mortgage broker in Woodstock, Georgia, where we do specialize in residential mortgage lending and creating environments for our clients to build generational wealth through home ownership. Been in the business for 24 years, and I've loved every minute of it since I've been in it. And our slogan has always been, and it will always be, that everybody needs a little grace.
Love that. Love that. All right. So let's dive in, you all, because look, today is about how do we help our buyers in this financial climate? And, I know my fingers are crossed. Let's hope that this month the rates come down, and let's see what our experts today have to say about that. I know that none of you have this magic crystal ball. I wish we did. But let's talk about that. How would each of you describe today's current financial marketplace, particularly in that mortgage sector? What are the challenges that buyers are facing today? Todd, let's start with you.
Yeah, I mean, it's certainly been a challenge for the past year, but I think there's still opportunities for buyers out there. I mean, I'm from what I know, inventory is tight, inventory is down, but being able to find different ways to get your buyers, whether it's, we got a lot of first-time home buyer products, down payment assistance, things like that, maybe target a little different demographic. Your low to medium income borrowers can qualify for a lot of down payment assistance out there still. We do some unique national down payment assistance stuff that we can go down to 600 credit scores and still give someone no money down type loans. I think the challenge right now is affordability, with rates increasing where they were, not only just to buy a home, but to afford the monthly expense to own a home. So that's certainly a challenge. But we're already starting to see a tick down in rates. I've actually refied some people this month from 6 months to a year ago that rates have dropped enough to do that. So that I think they will start dropping. Sooner the better for all of us, but that will still add challenges as well. But I think you got a lot of people sitting on 2.5%, 3% rates that just don't want to move. So that's going to be, maybe opening up here as the year ends. But one of the things I tell my agents is, when you're talking to buyers, is date the rate, marry the house. Rate's temporary. We can get it down in the next 6 months to a year, I'm sure. So if they really are out there kind of looking, just, if they really fall in love with something, marry that house, and then, the rate's going to be temporary, and then we can fix that down the road.
Awesome. Awesome. Dakota, same question. You want me to repeat it? Or are you good?
Yeah, no, I mean, I'm good. I think Todd kind of hit the nail on the head. The housing market, it remains competitive out there, especially for what we kind of refer to as the really good homes. It's cooled somewhat from the frenzy of the last couple of years, but certainly still competitive out there. Interest rates played a big role in kind of slowing the market, I feel like, in 2023, but I feel like we got hot again in 2024 with interest rates cooling a little bit. I'm in the same position as Todd. I've been starting to refinance folks, left and right here as well. So there's hope in the horizon that interest rates are coming down. We obviously don't have that crystal ball that everyone wants us to have, right? But if we're following, the Fed closely, if we're following, BLS, if we're following other, economic forecasts, we can see that inflation is starting to cool. And jobs are, unfortunately, unemployment's, kind of on the rise. So these are key indicators that rates are, on their way down, and we can kind of expect more of that in the future. Yes, affording a home is more expensive now than it has been in the past, but there are tools and resources that help those folks who need the assistance afford the home. Down payment assistance programs are on the rise, and I expect those to continue being a factor, especially for millennials and this first wave of Gen Z that's starting to come into the market. They're not having a hard time with the monthly payment, but more so the down payment. And so lenders and banks are starting to come up with, like I said, the resources in order to get those, younger generations into homes. So, and there's other creative ways, obviously, to combat the cost of home ownership, not just on the front end, but also month to month. So I'm sure we'll talk about that a little bit more as we get into this.
Absolutely. Thank you, Dakota. David.
Yeah, so I mean, obviously, like Todd had said, I think home affordability is probably the number one concern right now. Since the end of, or since the beginning of 2022, when we started seeing rates really increase tremendously due to the main culprit being inflation, that's when you saw just people throwing money in houses. We had people lined up down the street, and agents sending me pictures of people just lining up down the streets to get in the houses, because I think they knew what was going to happen. Rates were on the rise. And I think it's not so much that the rates went up, it's how fast they went up in the short amount of time that they did. And it caught a lot of people off guard. I kind of took 2022 as a shock and awe. People were just like, wow, what just happened? As a mortgage broker myself, and I'm sure my colleagues can relate as well, that it was just like, wow, what just happened? Because it was like overnight, they just jumped up tremendously. So yes, I think home affordability is probably the number one thing, but it's also understanding what's going on in the marketplace and what's really driving that. What I try to do on a consistent basis, on a weekly basis, is let all our referral partners know what is going on with rates weekly and what is driving it. So there are a lot of things that are determinant. Inflation is probably the number one culprit right now, but there is other things out there, such as wages and jobs reports. Those types of things are driving rates tremendously right now. We've got the CPI coming out this Wednesday, Consumer Price Index. That's the number one inflation indicator. And when that thing moves, either way, if it comes in higher than expected, you can expect our rates to move up a little bit. And it's not so much the rate, it's the pricing of the rate that pushes it up. So vice versa, if it comes in as expected or lower, we could see rates go lower. So we try to keep all our referral partners in the know what's going on, with rates on a daily and on a weekly basis. One thing I will point out, if you guys ever want to monitor what rates are going to do, because you're asking about this crystal ball. Well, my crystal ball is the 10-year T-bond. That's what I watch on a daily basis to get an idea of what rates are going to do. So the rule of thumb is this: the higher the yield, the higher the rates will go. The lower the yield, the lower they'll go. So you can watch that and kind of get a monitor on where that sits right now. And I'll give you an example. Right now, I believe it is sitting at, it's at 3.706. So that's actually good based on where it was. I mean, we got close to almost 5% in a yield last year. So, we've come down tremendously, and that's due in large part to, the Fed, so to speak, thinks that inflation is cooling. That does a large part to the wage reports coming in, jobs reports coming in, like jobless claims coming in higher, basic unemployment numbers coming in higher than what was expected. Those things are bad for the economy, but guess what? They're good for mortgage rates, because it means that it's going to push us into a deeper recession. And recession is always good for mortgage rates as well. So these types of things, and that's what we're kind of seeing right now. Inflation coming down. We're seeing jobs reports not faring as well as they should. So you're seeing a little bit of a shift in mortgage rates. I know that's a lot of boring information, but
No.
it's what we do on a daily basis to get an idea of what rates are going to do, because we do have a lot of agents that will reach out and say, hey, what do you think is going to happen? Well, I don't really know, but I can tell you what I do and what I watch to give you an idea of what's going to happen. So I really think that rates, the Fed's going to be coming out. They talked last month that they're going to cut rates. Now, by how much, we don't really know. It could be a quarter, it could be more than that. But again, the Fed funds rate's not really tied to mortgage rates, but it will affect what our rates do. Because if the Fed comes out and decides to drop the rates a quarter, guess what? Mortgage rates don't drop a quarter. That's stuff like equity lines that are tied to. But it will affect our rates in a positive way, I believe. And I believe that the trend will continue to trickle down following into the new year and everything. As far as like some just real quick hot products, basically we do a lot of just the conventional FHA, VA programs. We do have some 100% programs as well, but the majority of our clients that we deal with are either they've got money to put down, and then we do have some that are first-time home buyers that may need that 100% outlet that you can utilize too as well. Rates are really great right now, especially on conventional loans. We're sitting in the mid to high fives. FHA, I think we broke the sub 5 last Friday at 4 7/8. So the rates are out there. It's just making people aware of what's going on and keeping them in to know what's going on in the market. So.
Awesome. Thank you for that. And, one of the things that we're coming up here shortly on it being 30 days of what has changed in our industry as far as the National Association of Realtor settlement. And I want to touch on that because I want to touch on it from your all standpoint, because obviously, the way we're doing business and the way loans are being done has to change to some extent, depending on how, the buyers are paying commissions, or in the event that sellers are negotiating and paying, that buyer broker compensation. Can we all touch on just that a little bit? And I know it hasn't been a full 30 days since that's been in full force effect, but have you seen that? Have you been put up against that yet? How has that changed how you've handled the loan structure, or has it not become an issue at all yet? Todd?
Overall, it hasn't been an issue, but one of the things that I try to warn my agents to be careful when you're doing the 3 to 5% down conventional buyers, because Fannie Freddie, it's clear. I mean, it can be confusing, but it's not. You're only allowed 3% as a concession.
Yeah.
in those type of loans. So it becomes very important how the wording of the contract reads. We had one agent swear up and down he could put 6% to pay closing costs and or realtor fees, and that's not, you can't have it that way. You want to, when you're only allowed 3% concession. So if you're, doing those 3 to 5% down buyers, you just have to make sure it's two separate sentences. 3% goes to seller concessions, 3% paid by seller to the buyer's agent or something of that nature. So that's the only time I've really seen it come in or be a sticking point.
Good deal.
Yeah. Yeah, same thing as Todd indicated. And I think I tried to get ahead of this a little bit on my end and explaining to my realtor partners, that exact verbiage, and just making sure that that was clear from the jump. And I haven't had any issues with it yet. Everyone's been really good, especially my EXP folks. They're all awesome. So yeah, I haven't run into this yet myself personally. Hasn't been an issue, obviously. It hasn't, like you said, to your point, it hasn't been a full 30 days yet, but I think at least all of my realtor partners did a really good job of preparing for it and have executed it appropriately.
Wonderful. David.
The same with my colleagues. I haven't had run into that issue yet. I'm not saying that we won't. I think you guys are probably having more of a problem with it than anything, which I can totally understand. But I do, like Todd had said, with the interested party contributions that, that they're only allowed, I'm hoping that maybe if this does become an issue in our industry, is that some of these guidelines will be revamped, especially if you're putting the minimum down, in a conventional loan. If you put 5% down, you're capped at 3%. Compared to FHA, if you put 3.5% down, you go up to 6%. So you have some room there to roll that stuff in. So I'm hoping that maybe if it becomes a big issue, then that stuff can be revamped. But there has to be an issue for it to even get that far. But fortunately, right now, I haven't really had an issue with that because we've had, I think, with agents, they understand the process. And they got the other agent's best interest in there for them and just saying, hey, setting expectations up front that you're going to have to co-op, you know what I'm saying? So I think if so we just fortunately hadn't had to deal with that just yet.
Good deal. Good deal. All right. Let's talk about the types of mortgages and what's trending out there. And let's also talk about some of those products that maybe you all have access to that we just don't know about. I know that there's all kinds of things there's too many things out there, right? There's too many loan products. So talk to us about some of those that are trending and those unique ones that we may not be aware of. Todd?
Why don't I defer to Dakota? I feel like I'm stealing all her answers. Maybe let her lead off this
All
time.
right, let's do it, Dakota.
Yeah, no problem. Thanks for that, Todd. So I would say, you guys are probably familiar with the temporary rate buy downs. That one's still a big hitter right now. In our market, at least, selling them on, if a house has been sitting for a couple weeks, the seller's getting itchy, they want to sell. Not knocking that off of the purchase price itself, but rather giving those funds in the form of concessions so that, folks can get into a home for less in that first year or two. And that seems to be a really big one over here. That's helping make it more affordable. And of course, if there's any funds left over, applying that, to the interest rate or their closing costs, whatever is more important to them. But I think as far as, here on our end, that's a big hitter. Obviously, down payment assistance is coming into play quite a bit more. These days, I feel like I'm doing a lot of the down payment assistance for the first time home buyers. Ours specifically is based off of the AMI, right? So, and it's pretty generous, program. You don't have to be a first time home buyer to utilize it. So a lot of folks, even if they have the money, are starting to look at these, types of programs that just minimize their out of pocket expenses at closing, so that they can, afford the home right off the bat, put in the work that they need to. Those are really popular right now. What I've seen a lot of folks doing too, surprisingly, is, I like to give folks their options when they're purchasing a home. And, someone who's on the border between conventional and FHA, we know that the mortgage insurance premium and the monthly fee for FHA, you know, went down here recently. So sometimes, you know, those folks who are right there on the border between conventional and FHA, the FHA has been more affordable monthly and, you know, upfront at closing, or I should say closing costs. So I've seen more people go, you know what I mean? Just weighing their options more between different loan products is, I think, important, and giving folks their options. So that's mostly what I've been working with over here, you know, just playing the market more than anything. Just every deal is different, but the temporary rate buy downs are still really big here.
Very good.
Did I
Todd?
answer that? I'm sorry, did I answer that in full?
Yeah, you did.
Okay.
Thank you.
Okay, all right, thanks. All right, I tried to keep up with that. Go ahead, Todd, back to you.
Yeah, so your standard products are still obviously out there, but you know, one of the things that I've tried to keep an eye on with every conventional buyer is the home ready and home possible loans, because a lot of times you feel like those have to be first time home buyer and they don't. And there are income restrictions, but those rates are generally lower than standard conventional rates. So if we can squeeze somebody into that based on income, then you know we're definitely looking at that. Like I said, we have our own down payment assistance program that's an FHA loan. It's 100%. You have the first at 96.5, then we offer a payable second or non-payable second to get no money down for that. We're a little unique on VA, where we do not charge any lender fees whatsoever. So no underwriting fee, no processing fees, nothing like that to the veteran. So that cuts down their costs to buy a home. We do have a few areas. Atlanta's one of them. We have a 1% down program. Can also have a CLTV up to 105 on that. And we're finishing up a new product that I'm excited about that's like a cash offer. So similar to where we'll pre-approve someone and you can offer on your contract as a cash offer instead of financing, which will allow you guys to win more contracts. And then there's other things out there for like self-employed that's coming back, you know, bank statement loans, DSCR for rentals, debt service coverage ratios, and then you know, some little bit of like almost stated income type stuff. So those are out there, higher rates, more down payment, but if you have someone that has money, certainly a good option for them.
Very interesting, Todd. That sounds the cash one's very interesting to hear about how we can be writing cash offers, but they're actually getting a loan. So that's really interesting. David, what do you have?
All right. So to kind of feed off of what Todd and Dakota said, the temporary buy downs is still pretty hot with us. And you've got 5 different options out there for that, but probably our typical 2 hot ones are the 2-1 buy down, which gives them a 2% rate reduction, you know, for the first year, and then a 1% rate reduction for the second year. And then year 3 through 30, it'll cap out at their locked in rate. And then we've got a 1-0 buy down. That's probably another one that's hot. And that's just a 1% rate reduction for the first year. And that would be for someone like if you've got a seller willing to pay some closing costs, but maybe they don't have enough to cover the 2-1 buy down, then we can look at doing a 1-0 buy down. That's a lot cheaper, but still gives them gives them a rate reduction for the first year, which is, you know, which is great. Anything that's left over can always be used towards closing costs or prepaids, whatever's needed. And it doesn't have to be designated, hey, this is going for a buy down. It can just be straight closing costs, and we let our buyers or clients decide how they want to use it. We also, like Dakota had said, we give options, you know, because sometimes I will take a look to see if you got someone that's looking to put the minimum down, either it's, you know, 5% on conventional or 3% on conventional. And then we'll look at FHA too, as well as at 3.5%, just to compare to see what's going to be the most advantageous for them as far as their payment. Because like we talked about, it's about home affordability, and people right now are payment conscious. They want to keep their payment down as low as possible. So we will sit there and give them options and compare the two. And, you know, and I will tell them if FHA turns out to be a better option for them, that's the route we need to go, you know, because the payment's going to be cheaper. And a lot of times depending on the credit score, the mortgage insurance monthly can be cheaper on FHA than it can be on conventional with private mortgage insurance, especially if you go up to the max of, putting 97% financing and 3% down. So there's that. So the buy downs are definitely a hot item. I would say, like Todd had referenced, Home Ready and Home Possible. It's really just kind of, like he said, those rates are always better as long as you can fit within the 80% medium income limits for that county. They're going to get a better rate because they're trying to promote home buying and home growth in that area. So a lot of times, we can look at it and say, hey, if we just remove this one borrower and just have you on it, then you would qualify for Home Ready. Probably talking about anywhere from 1/4 to 3/8 better in rate, which is significant as far as a payment interest over the life of that loan. So there's that. And then another thing I wanted to kind of pitch out there, we have a buy before you sell program. So I know this was I think the market's shifting a little bit from a seller's to a buyer's market. But, there was a lot of sellers out there not willing to take contingencies regardless. They don't want to take it. So we have a program that we can utilize that allows that potential buyer to go ahead and buy that property without having to count that debt against them on that house that they currently owe. And it goes ahead and gives them the majority of the equity out of their property so that they can go ahead and buy that house so that they don't have to be contingent. So basically, it's a buy before you sell, because a lot of times you have to qualify with both payments if you're looking to be, contingent upon you selling. So in this case, they don't have to be. We don't have to count the debt against them. We can get a portion of their equity out so they can put down on the new house. They don't have to go deplete the reserve. Don't have the assets. They don't have to worry about it, because we can put them on this buy before you sell program. And the rates are the same. It's not a bump to the rate or anything like that. It's just a straight buy before you sell program that we've been utilizing and taking advantage of, because again, we're still, I think, like I said, I think we're in a shift, but it's still a seller's market a little bit. Sellers are not willing to take contingencies. So if we got a seller that's not willing to do that, then that's when we'll pitch. So we got a, buy before you sell program that they can take advantage of. So we have that program as well. And I think Todd had mentioned, about investor loans, DSCRs, and then bank statement loans. We've been doing a lot of those recently. We can go up to 90%, basically 10% down on the bank statement loan. And basically what that is, if you've got someone who's a self-employed business owner, we can utilize either 12 months or 24 months bank statements. We take that deposits, average those over that 12-month or 24-month period, and that's how we qualify them. And the rates, we got a guy that's closing into this month just to kind of give you an idea. Now, granted, he has a 750 credit score, but he's putting 20% down. But on this bank statement loan, he's getting 7% on a 30-year fix, and it's bank statements. It's not fully documented income. It's just averaging deposits from his business account. So there are those loans that are out there for those borrowers, that are self-employed, that maybe they make a lot of money, they just don't show it on paper. So we have those available too as well. So I hope that helps.
No, absolutely does. One of the things that I have learned selling real estate in other countries, and I do a lot of island property sales, is I am impressed by the amortization and the length of these loans. And, when I ask the questions of why do y'all amortize, for so long? And it's simply because people live longer in the islands, right? They're laid back, it's stress-free, I mean, there's not a care in the world. But because we are payment conscious and because real estate is costing more, I mean, we hear the 30-year fix, we hear 15-year fix. I know that there are some 40-year programs, but are we seeing anything change to get that amortization longer to help solve the affordability in the United States? Who wants to go on that? Because this is a curveball, you all. This was a curveball. David, you want to go? You're unmuted.
I don't think that I think the longer you hold a loan out there, think a lot of the investors, lenders don't want that. I think they
Yeah.
want to do either a 30-year, 30 years a standard term. There's still some 40 years out there with a 10-year interest only period to it. So I think that that's what got us in trouble back in 2005. We had, and I've been in the business since 2000, so I've seen that debacle kind of unfold. But even back then, when you start opening up that well of these loans and start creating these different loans out there with 40-year interest only, neg am arms, that sort of thing, you're going to kind of open yourself up to potentially loans going in default and stuff like that. I think that's probably why you haven't seen more of this stuff evolve. With a lot of the portfolio stuff that's coming out now, such as bank statement loans, 1099s, that sort of stuff that's coming out, that's kind of like your new stated income for this day without it being stated. It's a little more safe. It's still risky, but it's a safer option. So I don't know that, I won't say never, who knows, we could see a 50-year AM come out. But I think until, loans right now are performing pretty well, until you start loans not performing well. I just don't know that that's a possibility to happen down the road. But like I said, I'm not the guy to say that it wouldn't happen, because there could be a 50-year, there could be a 60-year that could come out. But
Dakota, your thoughts? I think she's got an opinion.
Yeah, I mean, he's exactly right. And it's important that we don't stretch this too much, right? Because then we will find ourselves in trouble again, like back in the day, right? But you got to have some kind of skin in the game. And to David's point, the loans that are out there, the bank statement, the DSCR, there's still a due diligence happening there. There's still, a system of checks and balances, more or less, right, to make sure that these loans aren't going to go into default, right? Foreclosures are at a historic low, and that's where we want to stay, where we want to keep them. We don't want foreclosures going up, so we don't want to expand those products too much, just because, if you can't, unfortunately, if you can't afford a home, you can't afford a home, right? And there's so much that we can do to try to help you with that, but you're going to have to, put some skin in the game, you know what I mean? And at the end of the day, extending that loan term is, I don't think it makes a ton of sense. I don't see it happening. But, like David said, never say never, right? It could happen. And if they come out, we'll push those too. And if that's what folks want and the demand is there, but, at the end of the day, I don't see that happening. And I personally wouldn't encourage it, but we'll see.
Todd?
Yeah, I think when you start getting into making out of the box loans, you get in trouble as a whole. I mean, I lived through the 100% stated income loans that got us really deep in trouble. Obviously, the neg am, and I'd have to look at it specifically, but I don't think a 30 to 40 years really making that big an impact, other than they're extending that payment out so far that it's going to be a while before they even get in a position to refi or something like that. So that's going to be a lot of interest at the beginning. So yeah, I don't think it's something I mean, they have brought the bank statement type stuff back, the DSCR, things like that, but it's, bigger down payments. So I think they've kind of learned from that, from the past mistakes on that.
Yeah, and definitely higher interest rates, right? You got to be willing to pay more each month to show your bank statement. That's for certain. All right. So let's talk about the mortgage approval process. You all have brought up, they're bringing back some of those things. I mean, they're not as easy as it was back in 05 and 06, when if you could walk, talk, and breathe, you could buy a house, right? I mean, literally. And I was in the business. This is my 25th year in real estate. And I made a pile of money in 08 when it all came tumbling down. I mean, I'll be the first to admit it. Piles of money when it all came tumbling. And we don't want to get back to that, because my gosh, I had my fill of short sales. I don't ever want to go back to doing 600 short sale closings a year, because man, that was work, you all. It was work. It was work, and it was not good. But let's talk about this mortgage approval process and credit considerations. What are the key factors impacting mortgage approvals in today's market? And how can agents help clients prepare for the mortgage process, especially with credit concerns? And I'm sure that, this has been around obviously for a very long time, but is there anything new that we need to be aware of? And don't forget too, you all, we have newer to the business agents on this call too. We're not all seniors we're not all senior citizens in this industry, okay? All right, let's start with you, Dakota.
Yeah, so as far as getting pre-approved, like I just talked to a client 2 days ago, and their agent's on the line and they're talking about, hey, our lease isn't up until, April of next year. What do we need to do? And, for me, it's like as early as possible, get pre-approved and, get dialed in. If you've got folks telling you, hey, I don't want to move for 6 months, well, they should still get pre-approved, because I've had folks who said the same thing. And, 3 months down the road, they're ready to get pre-approved and kind of start their home search, and something came up on their credit that they weren't expecting, or, what have you. So just getting that dialed in early is certainly encourageable for those agents who are having conversations with folks who are saying it might be a little while, it might be 6 months to a year, at least getting encouraging them to get their ducks in a row. But obviously, the pre-approval process is pretty standard. Did you want me to explain? Did you want me to go through that? I apologize yeah.
No, absolutely. If you want to share some of those details, that would be great.
Yeah, absolutely. So that initial conversation, I like to do all of mine over the phone. I know that a lot of lenders have online applications and they direct folks accordingly, but I really like to hop on the call with my clients. I think it establishes a personal relationship. I think it gives me the opportunity to talk through their goals, and you know what I mean, the specifics of their loan and what they're trying to achieve with their home ownership, with their purchase, whether that be primary, secondary investment, what have you. So just having that initial conversation, and then of course we collect all that basic information about them, who they are, where they live, where they work, what their income looks like, and then we back that up with paperwork, right? So provide your most recent W-2. I need a pay stub. If you have mortgages already, let's document those, and just getting all of those ducks in a row, just to make sure that someone is really well qualified. These are, just industry standard at this point.
David?
Yeah, so I'm kind of like Dakota too. I'm kind of old school when it comes to pre-approvals. I like to talk to each and every person that we pre-approve, because I want to be able to get a snapshot of what they're looking to do, but I'm also going to ask some key questions that's going to open up some other questions. One of the biggest things I never want to do is put someone in your car as an agent that's not qualified, and because that's a waste of your time, it's a waste of my time, and it's a waste of their time as well. So we're going to ask the right questions on the front end, and you need to be partnering with a mortgage lender, which I'm sure that Todd and Dakota do this too, but they ask the right questions. So you need to partner with the right person that's going to ask those questions, so that when they're put in your car, and they're starting to look, they're good to go. So the pre-approval process is important, and you can get a good snapshot of what those people, what they're looking to do. You can get an idea of where they stand. But it also will allow us to dig deeper, if we need to. Having good relationships with your underwriters is key, because if I have a scenario, I can actually pick up a phone, I can text my underwriters because I have their personal lines, and I can get in touch with them and get a scenario answered right away. Because if you're wanting to know, my goal is to get you an answer as soon as possible, because as loan officers, we're always on call. There is no Saturday, Sunday. We're just always on call. It's just the way it is, just like you guys are. So the pre-approval process is important, and we do make that an important piece. And that's why I like to be involved in that, especially getting to know those persons, just like Dakota had said. As far as the approval process, one thing, it's not that hard. It really isn't. It's a simple process. If you've done the job on the front end, ask the right questions, all you're basically doing is collecting all their docs at that point. I will say, one of the things we're starting to see a lot of is we have an automated system, which is just AUS. It's Fannie Mae and Freddie Mac based. A lot of times we're getting what they call PIW, which is a property inspection waiver. And there's really three things that really determine it. If they're putting at least 20% down, they got to get credit score. And if the purchase price is within range, a lot of times we're getting these property inspection waivers in there. And what I do is when I get that, I automatically alert the agent and alert the borrower to let them know that, hey, we got a property inspection waiver. So you got to worry about an appraisal coming in or not. It can save the borrower anywhere from $485 and up in an appraisal they didn't have to pay for. So there is that part of the process, and that will actually speed up the process even more, because I know you guys have a finance and appraisal contingency that you like to put in there. So that will eliminate the appraisal contingency. As far as the actual approvals from an underwriter, we're getting those within 24 hours once the loan is submitted. So I'm pretty sure that Todd and Dakota are doing the same thing. It's pretty quick. But once we go through that process, it's fairly simple. It's just basically, we're checking off all the boxes and making sure that, everything is done in a timely manner. Because my goal, and we always hit this goal, is to have everything cleared to close and to have our CD out a week before closing. So that is the goal, because I don't want our referral partners to be waiting on us at all. We just want to be waiting for the closing to get there. So
it's such a good point. If I can just say one more thing, David. I mean, such a good point is, our goal is to get that to you guys as quickly as possible. The appraisal waivers are so important. For any of you agents, you have your own, mortgage connections. If your client's putting, 20% down, make sure they're running that before ideally before you submit your offer. Cause I mean, at least here in the Indy markets, it's been really successful to getting an offer accepted, even if you're coming in a little bit less than another party. If you got that appraisal waiver, that gives that seller security, right? That peace of mind that they don't have to worry about that appraisal coming in or maybe being short or what have you. It's such a huge tool. Any of my clients that put at least 20% down, I'm running that before they submit the offer, because, that can be a game changer right there. It gets it done faster. With an appraisal waiver, I can turn around a loan in about 9 days. So, I mean, it's just huge as far as timing is concerned. Yeah, great point there, David. That was great.
Awesome, Todd.
Yeah, I mean, it sounds like we're all about the same on the pre-approval process. I'd much prefer to just talk to a client. I just think you can build that relationship and the trust at the beginning. One of the things, part of that pre-approval process, as you're getting a buyer is, one of the things that have kind of not hurt pre-approvals, but made clients confused is Credit Karma. Thinking they have a certain score, and that's not really a hard pull. That's not an actual true score. So asking someone, up front what they think their credit score might be. My experience is if it's, mid 600s or higher, it's usually pretty close. But when you start getting down in the low sixes, it probably will come back in the fives. So that can confuse people because they think they have a certain score, or they may only have one credit score on the Credit Karma when we're going off of the middle score of 3. Obviously, in this day and age, credit card debt is killing people. But one of the things that I see a lot of is people renting and thinking they can afford an $800 car payment. And that's great. They probably can at the time, but that's going to impact their approval process to buy a house. So, there's not as much as you guys and us are regulated. Somehow auto dealers are not, and they can give away these huge car payments. And the last thing is just being honest with their income. So making sure you ask your lender, whoever may be, is asking the right questions. Variable income can really kill a deal where they're on an hourly and they may go up, or they haven't worked there long enough to count overtime, but they think they make more. So those things are things that we have to keep track of. But I think that's the main keys to when we look at the beginning, to try to make sure that we don't have any issues at the end. We have things like lock and shop, where you can lock in a rate. That's not going to matter as much if rates start going down, but when they were going up, lock in a rate and still be able to shop for a house. You don't have to lock it on a specific house. Things like that. We can do a full pre-approval where we can have it underwritten within a day, and they're not just pre-approved, they're actually full underwriting approval pending the house. So we do some unique things there to kind of help that process go along, and get things done. And again, like my colleagues have said, I mean, I'll close the loan as fast as you want it closed. If it needs to be put at the top of my list, I'll put it at the top of my list. I'm an empty nester now, so I work 24/7. I'm available 24/7. If I don't understand people in this industry that don't pick up their phone. So I answer the phone, and if I, for some reason, can't, I text that person back immediately and say I'll call them right back. So I just think that's important in this market, and it's just confusing how some people don't do that. But those are the things that I look for.
You all, we have a few comments in the chat that I want to make sure that we get to. I know Dakota is licensed in Indiana and Florida to do loans. David, can you do loans in all 50 states?
No, we cannot.
Okay.
We're licensed in Georgia right now. We're in the process of getting licensed in Florida and Tennessee.
Okay. So Georgia, Florida, Tennessee. And then Todd, you can do loans everywhere. 50 states?
Just about. We don't do New York, Alaska, and Hawaii, but
Okay.
everything else. I saw somebody on there in Nevada. Yes, I can do Nevada, Las
Perfect.
Vegas. So
Okay, so Todd is anywhere but Hawaii, Alaska, and New York. So that's pretty good mileage you're covering, Todd. So that's pretty awesome. Pretty awesome. So, all right. So let's see here. We've got let me look at the questions here. So Kenneth Collins put a comment in. He said, if I'm hearing you correctly, the 40-year loan is bad thing for buyers or the bankers or the financial institution. Is it bad for the buyers or is it bad for the financial institution? You know, I think what we were hearing, it's bad for both. It's heavy loaded with interest, right?
I would argue it's bad for both just because it's risky, right? It's risky for both. If you can't afford, I mean, at 30 years, kind of the standard for a reason, right? That if you can't afford a home on a 30-year term, that's a lot of years. If you can't afford a home on a 30-year term, you know, I don't know if you should be buying a house necessarily at this point, I guess personally, but I think it's just, loans are all about, for banks, it's all about risk layering. And if someone needs 40 years for this house versus, somewhere in that 20, 30 year, range, I should say 15 to 30 year range, I don't know, maybe you got to find a different house. You're pushing your limit there too, right? Not just the banks offering you a riskier loan program. That's my opinion.
Well,
yeah, one of the keys is building equity, right? So you go 40 plus, you're paying so much in interest, you're not really building that equity very quickly. So that makes it harder down the road to do something and things like that as well. So I agree with what she said there, Dakota said.
I would think that if you're going to look to doing if a 40-year was even a possibility, because a lot of times those are 10-year interest only with 30 years left after the 10 years.
Mm-hmm.
And I think that's what a lot of lenders try to get out of, because what happens is you got used to paying that payment over 10 years. And when that thing, if you're in it for 10 years and it goes to when it, fully amortizes to a 30-year fix, that payment's going to jump up significantly. And that's where it creates chaos and can cause problems. But I would say if you're looking at someone that, hey, I want to get my payment down, that's where you go back and see if a seller will be willing to do maybe a temporary buy down. Because like Todd had said, right now you're basically, if you find the house, you marry the house and you date the rate. That's what you're doing. Because eventually rates will come down. And at that point, you can refinance. So that's the whole goal of the temporary buy down. These were big back in early 2000s. When rates were higher, and they came back out in 2022, just because, like I had said, it's like a shock and awe with the rates going up the way they did. So that's why they brought the temporary buy down out. So take advantage of it. If you got a seller willing to pay closing costs, take advantage of it. And then within the 2 to 3 years, refinance out of it, rates come down. So that would be my thing.
Yeah.
Awesome. Well, I think this was amazing today. I appreciate each and every one of you. And before we call it a day, I mean, is there anything that you guys want to add to the conversation that is just pure value for these agents to succeed in this industry? Todd, I want to start with you on that one.
Yeah, I mean, the last topic there was something to do with rates, and I know we discussed that a little bit, but I do want to kind of caution people if they start paying attention to the bond and this, that, and the other. the government never lowers rates as fast as they raise them. So, that gets brought up a lot. Well, I heard, some will be put out on the internet and people instantly think, well, rates went down. Well, they're not going to go down that quick. And that's how they make their money. The banks make their money. So they're, even with these, future rate drops, it may affect it a little bit, but I wouldn't look for a huge drop quickly because the banks are sitting on all these loans at 7.5, 8%. They're not eager to lose those. And they know what's coming. Refi boom will be coming. And so it just the way the market works, it's not going to come down as quick as it goes up. So just be conscious of that. And stuff like that. But other than that, no, I mean, I think I appreciate the call again, and I look forward to, maybe doing some business with some people here in the future.
Thank you, Todd. We appreciate you so much. Dakota?
Yeah, I mean, Todd kind of hit that on the head. Is, everyone's like, oh, the Fed is meeting, they're gonna, reduce interest rates. Well, the kind of expectation, this month is that, Fed is going to cut by 25, right? Or a quarter, I should say, not 25, but a quarter, and everyone thinks, oh, well, rates are going to drop by a quarter. And, to David's point earlier, that's not really impacting our rates necessarily, not directly, right? But we'll have a little trickle down there, but we're already kind of, anticipating that, 25 in later this month, right? So, the market's already pricing for it. So just having that in mind when you're talking to your clients, or if you hear a client say, well, I heard the Fed is going to cut rates later. I'm dealing with this with a client right now. I'm trying to get her to understand, like, the market is already pricing for that, that quarter cut. So, we might see a little bit more movement, around the time of the Fed meeting, but I'm not super optimistic about it. There's also other, factors that play into that, but it will be a really slow, the Fed they're kind of in between a rock and a hard place right now, where they have to, they're going to start lowering rates, but it's going to be slow. They're not going to, cut them by 0.5%, whatever overnight. And that's going to directly impact us or directly reflect on our rate sheet. So just keeping that in mind when you're talking to clients, keeping them, in the know. And if you guys want more information on how, rates are calculated on our end, and what, data to look at to understand where rates are trending, I'd be more than happy to talk through that. But, the other thing that I like to tell realtors is, and my realtor partners are really good about it. I'm not here to, say anything negative necessarily, but, like, if it comes to finance, make sure you're putting them back in touch with their loan officer, with their mortgage consultant, with their bank, not, leaning on your lending partners to establish those numbers, and, getting a good idea of where they need to be, or where they want to be, or where they actually are. Instead of I've had some, newer realtors who are, taking a little bit of that into their own hands. It's caused a little bit of issues. So just making sure anything numbers wise, push that back on your lender, so that you guys can stay on the same page together, so that you create that unified front, and the consumer feels really comfortable. And everyone's on the same page moving forward. That would be my one, piece of advice, is delicately approaching anything with finance side by side with your lender partner.
Awesome, Dakota. David?
All right. So if there's one thing I can say to tell your clients, because I tell our clients, the ones that you refer to, is that do not play the market. Lock your. That is very significant right now with the market being so volatile. And the reason why I say that is because we have a float down option that we can utilize and take advantage of. And I do take advantage of it. I just floated 4 people down last week because the market improved. So it doesn't cost them anything to do that. We pitch that on every person that's referred to us, and we're going through that process. We will tell them up front and saying, look, lock it in, because here's the deal. If the market improves, I can float you down, and it doesn't cost you anything to do it. And you don't have to worry about it. I monitor it for you and take advantage of it. So that's one thing I would walk away with, is your clients need to lock their rate in. Do not play this market, because it's crazy. It's chaotic. It can move up and down, and it can change really quickly. The other thing I just want to say is thank you for the opportunity to get to talk with you people. And if you will, follow us on Facebook, Grace Mortgage Services. We're both on Facebook and Instagram. We post our rates every Monday morning. Actually, it's going to be this afternoon since I've been on this call with you guys, but it's been a pleasure. But we'll be posting those today, and you can just follow us along. We do give a lot of market updates and give some nice tidbits about the mortgage ins and outs of our business and everything. So, but again, thank you for the opportunity. It was a pleasure.
Thank you all so much. We greatly appreciate each and every one of you, and we will definitely have you all back someday because this is such an important piece of our business, and we're just grateful that you took some time out of your day to pour into each and every one of us here at our Grow Global community. So don't forget, every single Monday at this time, we are pouring into you with all the different topics to bring into your business. John, we have next Monday,
Next Monday, we talked about it a little bit earlier, but before we get into this, if I could very quickly ask our panelists, if you want our community to connect with you on social media, if you want to drop your links in the chat, they can connect with you, follow you, what have you. But I'm gonna share my screen a little bit while you guys are doing that. And thank you to all three of our panelists. Todd, David, and Dakota for showing up today and pouring into our community. But next Monday, we talked about this a little bit earlier. Alex Montagano, top agent in Indianapolis, absolutely crushing it. Alex has scaled his business by using virtual assistants, outsourcing the tasks that that kind of get in the way and bog you down. And Alex's business is just absolutely blown up since he started using a VA. And who knows, maybe your business is not even ready for a VA. That's okay. Come anyway, because at some point in time, your business is going to be ready. So you want to kind of understand what that looks like and maybe what you have to do to get to that point. And Alex is going to have Justin Nelson on, who is the owner of the virtual assistant company that he uses. So you'll be able to hear two perspectives. You'll be able to hear the services and how Justin implements them with his clients, and you'll be able to hear from Alex on what he's done specifically to take advantage of this. So next Monday, it's the same time, and really what I'd recommend is put Monday on your calendar. Put it as an appointment in your calendar so you know to be here with us every Monday, because we're always going to be bringing you great information to help you grow your real estate business, just like we did today with our excellent panelists. So we want to thank you guys for being here today, and we'll see you guys next Monday. Have a killer week. Go out and crush it, guys.